Imagine trading not stocks, not crypto, but ideas. Instead of buying Apple or Bitcoin, you're buying the odds of something happening. That's what prediction markets like Kalshi let you do. Trade on the outcome of future events. That means you don't have to worry about time decay like you do with options trading, or fundamental analysis like with investing in stocks, or even technical analysis like you do with crypto. And if that sounds wild, just wait until you see how these $1 contracts actually work. Today we're diving into one of the most fascinating new entities of modern finance, prediction markets. They sit at the intersection of market psychology and probability. You're not trading companies, you're trading beliefs. We're going to walk through what Kalshi is, how to buy and sell contracts, how the math works, and even how you can exit early or set limit orders like a pro. Kalshi is the first CFTC regulated event trading exchange in the US. Think of it as the CME for futures events. You trade in US dollars, not crypto, and every market revolves around a yes or no question with a clear, verifiable answer. For example, will the Federal Reserve cut rates in December? Will Bitcoin hit 150,000 before year end? Who will be the top artist on Spotify this year? Each market is built on a $1 contract. If you're right, it settles at $1, and if you're wrong, it settles at $0. That's it. Check out the link in the description of this video to get $10 for free for your Kalshi account. It's also at the top of the PDF that goes along with this video, also found in the description. Let's look at this live example, the Spotify market. Who is going to be the top artist on Spotify this year? Bad Bunny yes contracts are trading at 90 cents. That means the crowd thinks he's got a 90% chance to win. The no contracts trade around 11 cents because yes and no always add up to around $1 minus a tiny spread. If you buy the yes for 90 cents and he wins, you make 10 cents per contract. If you buy the no for 11 cents and he doesn't win, meaning you're correct, you make 89 cents per contract. So cheap contracts mean low probability but big upside. Expensive contracts mean high probability but small payout, just like options pricing. The main takeaway here is that these are contracts, and once the event is over, the contract either settles at $0 or $1. So when you buy a 90-cent contract, you are risking 90 cents to make 10 cents. When you buy a 10-cent contract, you are risking 10 cents to make 90 cents per contract. So if you buy 100 contracts of something and you are correct, you get $100 back since it's $1 per contract. Your profit would be that $100 minus the cost of those 100 contracts. If those contracts were originally bought for 20 cents, that means that it would cost you $20 to buy 100 contracts, and you made 80 cents per contract profit, meaning for 100 contracts, you would make $80 profit for risking $20. When you click buy yes or buy no, you're buying contracts at a specific price. You can also set a limit order. For example, I only want to buy if the price drops to 40 cents. Kalshi's order book shows you real-time bids and asks from other traders. Just like a stock exchange, your order sits there until someone matches it or you cancel it. And yes, you can sell early. You don't have to wait until the event resolves. If you bought yes contracts at 40 cents and they're now trading at 70 cents, you can lock in profit right away. Every trade is a simple buy or sell of probability, and you can take profit or cut loss whenever you want. These contract prices move constantly, just like a stock chart. They go up when demand for that side increases, when more traders believe that outcome is likely, and they fall when sentiment cools or new information hits the market. A breaking headline, a new data release, or even social media hype can shift those odds in seconds. So when you see a contract climbing from 40 cents to 70 cents, that's not random, that's the crowd's confidence changing in real time. Each tick on the chart is the market literally repricing belief. If you're trading the top Spotify artist of 2025 and Taylor Swift all of a sudden drops an impromptu album that does really well in Spotify, her contracts might move up significantly. And if you bought that contract prior to the album drop, you can sell for profit. You don't have to wait for the event to settle, in this case for the top Spotify artist of 2025 to be decided. So for example, you can buy a 20-cent contract on a baseball game in the second inning when the score is 2-1 and sell for 80 cents in the 8th inning when the score is 5-1. You don't have to wait until the game is over, because like Yogi Bear said, it ain't over till it's over. The order book shows the current supply and demand for each side. This is great to look at if you're trading these contracts. The green numbers are bids, people wanting to buy yes at those prices, and the red numbers are asks, people willing to sell. Every time a trade happens, the price ticks, and that tick represents the crowd's collective belief shifting in real time. Let's say the market asks, best AI of 2025. There are options like Gemini, GPT, and Grok. Let's say you don't know who will win, but you think for sure that it won't be Gemini. You look at the board and see the no side trading at 29 cents. That's basically the crowd saying, we think there's about a 29% chance that it won't be Gemini. You decide to buy $5 worth of no contracts. Here's what actually happened. Each contract costs roughly 29 cents plus fees. So $5 buys you 16 contracts. Now Kalshi rounds the math so your maximum payout is an even number. In this case, $16 if you're right. So because of this, your total spend won't be $5 exactly, it might be lower. In this example, it rounded to $4.88. There is also a fee included in that calculation automatically as well. Both the buyer and the seller pay a transaction fee on trades. The fee is calculated based on the contract's expected payout. Kalshi charges this fee to the user on each side of the trade. It's roughly 0.5% to 2% of the expected earnings per trade. Now, how do you know if you're right on the contract? Well, you scroll down to the rules summary. In this case, if Google has a top-ranked LLM on December 31st, 2025, then the market resolves to yes, and the outcome has to be verified from the LM Arena leaderboard. You can also click View Full Rules for a bigger breakdown. If Gemini is not the top-ranked LLM on December 31st, 2025, each of your 16 no contracts settles at $1. So you get $16 back, so your profit is $16 minus $4.88, which was your cost, so $11.12 profit for risking roughly $5. If Gemini is the top-ranked LLM on December 31st, 2025, your contract expires worthless. You lose the $5 that you put in. That's your max loss. You can never lose more than your initial cost. And remember, you do not need to hold till resolution. If sentiment shifts in your favor, you can exit and bank profit before the event is over. Or you can use Kalshi as a hedging tool. For example, if you're long growth stocks that love rate cuts in your stock portfolio, but you're nervous about a hot CPI print, buy a small no rate cut position on Kalshi. If the Fed doesn't cut, your hedge pays out and softens the blow of your stocks going down. Kalshi still runs fully off-chain under US law, but you can fund it with crypto thanks to its partnership with Zero Hash. That means you can deposit Bitcoin, USDC, Sol, and Sui, and it gets instantly converted to USD inside your account, usually in under 30 minutes. No bridges, no volatile wallet risks, just fast funding for your trades. Kalshi is the regulated Wall Street-style option. Polymarket is its decentralized on-chain cousin. Polymarket runs on USDC stablecoin on Polygon, open to global users, but it's not CFTC approved and has blocked US traders before. Kalshi focuses on compliance and legitimacy. Polymarket focuses on freedom and transparency. Both let you trade belief, they just live on different sides of the regulatory spectrum. We focus on Kalshi due to being regulated and safer. So why should a stock or crypto trader care? Well, because Kalshi lets you see sentiment before it hits the price charts. If the rate cut market drops from 80% to 60%, you know expectations are fading. That's a warning for risk on assets. If ETH ETF approval odds are rising but price hasn't moved, you might be early to the trade. Prediction markets quantify what Twitter argues about. They turn narratives into numbers. I always say that markets move on belief, not truth. Prediction markets are belief made tradable. Every price on Kalshi is a snapshot of collective emotion. So if you study how those odds shift, you learn how crowds process information. Fear, hope, confirmation bias, everything. It's like watching market psychology with the volume turned up. And remember, just because you can trade an event doesn't mean that you should. Prediction markets can feel deceptively simple, but they trigger the same emotions as options and leverage trades. Start small, treat them as data tools first, and trade second. Your goal isn't to gamble on headlines, it's to understand how sentiment shifts and use that as an edge. So that's Kalshi, a regulated real money way to trade the future. You're not just trading events, you're trading expectation. And in a market driven by emotion, expectations are everything.